Today we're going to talk about partnerships and how they work. What is a partnership and what kinds of partnerships are there under the various state laws? Well, the most basic example of a partnership is a general partnership. I walk up to you on the street, I know you, I shake your hand and I say, partner, let's be partners. Let's go invest in that real estate venture down the street. And we shake hands and we agree to be partners, and then we start operating as a partnership. That's how simple it is to create a general partnership. But watch out for general partnerships. They're really a thing of the past. We don't use them very much today, and I'll tell you why in a second. Then there's the limited partnership, or LP. In a limited partnership, by state law, you almost always have to have one general partner, referred to as a GP, and one or more limited partners. So in Texas, for example, when we set up entities, we use limited partnerships pretty frequently. We'll have a general partner, and we may have one, we may have 50 limited partners in the limited partnership that we're setting up. There's also something called a limited liability partnership, which became extremely popular in the wake of the Enron debacle that put away one of the greatest accounting firms ever to be on earth, and that was Arthur Andersen and Company. It was put out of business because it was essentially a general partnership among all of its partners around the United States and around the world. And several of the partners in the Houston office were involved in the Enron crisis that led to the massive liability and massive failure of Enron, which ultimately led to the demise of the great Arthur Andersen accounting firm. So these LLPs are limited liability partnerships, and they're usually used by professionals, accountants, lawyers, sometimes doctors, although in some states it's not permitted. And the LLP basically says that my liability as a partner, professional in that firm, is limited to my own negligence and my own torts, the bad acts that I've committed. But the partnership debts, I may have a pro rata responsibility for based on my ownership of the partnership. But I'm not liable for my partner's malpractice or bad things that they may have done. Then we've got the limited liability limited partnership, which is also a relatively new creature of statute, and it's not found in all of the states, but it operates somewhat like a limited partnership. However, the key distinction is that you can limit the liability for a general partner in an LLLP if an election is filed and other requirements are met. So let's talk about general partnerships. I mentioned you need to be careful and you need to be cautious if you're forming a general partnership. And a lot of families enter into general partnership arrangements not really understanding what they're getting into. A partner in a general partnership is personally liable for all business debts incurred by the partnership, even if they didn't agree to be liable for it. It basically refers to the concept of joint and several liability, which means that even though you were, say, a 50% partner with your brother or your cousin in a partnership, and your brother or your cousin go out and incur a debt, you're liable for the whole debt if it's in the name of the partnership. Any individual partner in a general partnership generally can bind the entity to a contract or a transaction. So it's risky to get involved in a general partnership. How are partnerships taxed? Well, they're basically pass-through entities, meaning that revenue minus expenses and certain other items, such as credits and charitable deductions, are passed through to the partners on a Schedule K-1 that's attached to the partnership return, which is referred to as Form 1065. So usually, with very few exceptions, some state law exceptions, partnerships do not pay tax on their income. And as I mentioned, income, deductions, credits, and losses pass through to the owners. But then the question is, can the owners use all of those losses that are passed through to them? There are three basic limitations that we always point to. One is limited to your basis in the partnership, which equals the amounts that you contributed to the partnership plus whatever debts are allocated to you under the debt allocation rules in the partnership provisions of the tax code. There's also a risk known as at risk. Are you really personally liable for this debt that the partnership incurred? And then there are some exceptions to that. If you're not able to satisfy these two limitations, you can't claim the loss, and the loss is suspended and carried forward. The Tax Reform Act of 1986 introduced the passive loss rules under Code Section 469 of the Internal Revenue Code, and that further limits your ability to claim losses currently and offset them against other income, like your compensation income that you generate. These passive loss rules are very complex and really would involve an entire separate presentation that might be twice as long as this presentation is today. Now let's talk about liability in partnerships. Again, in a general partnership and in a limited partnership, the general partner is personally liable for the debts of the partnership. So in many cases, in virtually all cases that I can think of, you want to have a limited liability entity serving as the general partner or general partners of a general partnership or limited partnership. In that event, you might use a corporation or a limited liability company, or in some cases, you might use what we refer to as an irrevocable trust that could serve as the general partner and limit the liability of the entity to basically the corporate general partner or LLC and not expose your personal assets. Let me give you an example. Your partner, Bill, goes out, signs up with the local bank, takes out a high interest rate loan in the name of the partnership, proves that he's a general partner, and the bank lends him the money without your knowledge or your consent. If the partnership is a general partnership, you're fully liable for the loan. Again, can't emphasize enough, partnerships, sole proprietorships, any business should get commercial insurance, business insurance, errors and omissions insurance, general liability insurance, workers' compensation insurance if you've got employees, umbrella insurance if it's available, and other types of insurance, including cybersecurity risk insurance, which is really important today. And then, of course, you want to enter into a very clearly written partnership agreement. But if I'm in your shoes, I would use an LLLP, a limited liability company, or a corporation if I were operating the business. Partnership agreements are really important to flesh out the liability, governance, and other aspects of running the business. It allows you to allocate profits and losses and cash flow. It allows you to restrict the transfer of the interests. And it deals with such situations as retirement or death or disability or the withdrawal of a partnership. Without an agreement, you're subject to the statute in the state in which you operate. For general partnerships, those statutes are commonly known as the Uniform Partnership Act or the Revised Partnership Act. For limited partnerships, it's known as the ULPA or the Uniform Limited Partnership Act or Revised Uniform Limited Partnership Act. In California, for example, these statutes would restrict you from adding a new member or new partner to the partnership without unanimous consent of all of the partners. You may not want to restrict the entity that much. A partnership cannot avoid personal liability for business debts, even though it says that you are limited to the liability that you might have in the partnership if it's a general partnership. And general partners can't limit their liability, but they can certainly seek contribution from other general partners or other partners that they're working with. A partnership agreement also is not allowed to restrict a partner's rights to inspect the books and records of the business. And you cannot limit the rights of third parties in relationship to the partnership. For example, in the example I used before where Bill wanted to enter into this borrowing arrangement with a third party on behalf of the partnership, the third party knows that Bill has authority, apparent authority, to act on behalf of the partnership. So the partnership agreement can't restrict that third party's right to enter into that agreement with Bill because the third party doesn't know about it. So unless the third party is actually bound to this agreement, they're not bound by your partnership agreement that limits your liability to the partnership and therefore the creditors of the partnership. You also, in a fiduciary situation, you cannot eliminate or weaken the fiduciary duties that are owed by each partner to the other. The duties of loyalty, the duties of care, the duties of prudence, the duties to administer the partnership properly.